Have you ever pondered over how a company with limited capital can acquire another much larger entity? The answer to that riddle lies in a financial strategy known as leveraged buyout, or LBO. In the world of finance, the term leveraged buyout often echoes in boardrooms and investment circles. But it's a much easier concept to understand. It's a strategy that has been employed by many companies to grow and expand their operations. Welcome back to our channel, where finance meets clarity. Today, we're uncovering the secrets behind a strategy that's reshaped businesses and made headlines: the leveraged buyout, or LBO. But what exactly is an LBO, and why does it matter to investors, companies, and even the economy? Stick around as we break it down. Quite intriguing, isn't it? But first, what's a leverage, you might ask? Financial leverage is a strategy that involves using borrowed funds to increase the potential return on investment. Essentially, it amplifies the outcomes of an investment by increasing the amount of money that can be put into play without requiring the investor to commit more of their own capital. The core idea is to borrow money at a lower cost of interest and invest it into assets or projects that yield a higher return than the interest rate. For example, if a company takes out a loan at an interest rate of 5% to invest in a project that returns 10%, the company effectively earns a 5% return on borrowed money, thereby increasing the overall return for its shareholders. Now that we defined the financial leverage, let's delve into the fascinating world of LBOs. A leveraged buyout is a financing tool where a company, or more specifically, its stockholders, uses borrowed funds or leverage to acquire another company. Imagine acquiring a company not with a treasure chest of gold, but with a smaller chest and a promise to pay the rest later. That, in essence, is an LBO. It's a financial transaction where a company is bought using a significant amount of borrowed money, with the acquired company's assets often serving as collateral for the loans. LBOs can transform companies and yield substantial returns for investors. But how exactly does an LBO unfold? Let's dive into the phases that make up this complex process. Phase 1. Identification and preliminary assessment. It all begins with the hunt for a diamond in the rough, a company ripe for acquisition. Investors seek out targets with strong cash flows and potential for growth, but perhaps undervalued by the market. A preliminary assessment sheds light on the financial health and market position of the company, guiding the decision on whether to proceed. Phase 2. Detailed analysis and valuation. Once a target is in sight, a deeper dive is essential. This phase involves meticulous due diligence, examining the company's operations, legal standings, and financial intricacies. Armed with this information, investors develop financial models, forecasting the future and valuing the company through various lenses to determine the viability of the LBO. Phase 3. Financing strategy and structure. With evaluation in hand, the next step is figuring out how to finance the deal. A delicate balance of debt and equity is struck, optimizing the capital structure for maximum return while navigating the risks inherent in leveraging. Negotiations with banks and financial institutions are crucial at this stage, as securing favorable terms can make or break the LBO. Phase 4. Negotiation and acquisition. The stage is set for making an offer. But arriving at a mutually agreeable price and terms requires careful negotiation, often involving multiple stakeholders. Once consensus is reached, the deal is closed, the financing secured, and the company begins its new chapter under the acquirer's ownership. Phase 5. Post-acquisition management. The true challenge begins post-acquisition, as the new owners implement strategies to enhance operational efficiency, cut costs, and spur growth. The goal is to increase the company's value significantly, making it a more attractive proposition for the eventual exit. Phase 6. Exit. The final act of the LBO saga involves exiting the investment at a profit. Whether through an IPO, a sale, or another financial arrangement, the exit strategy is executed with an eye on maximizing returns for the investors who took a chance on transforming the company. Each phase of an LBO is a stepping stone towards potentially lucrative outcomes. though not without its risks and challenges. This financial strategy requires a blend of analytical prowess, strategic foresight, and a bit of daring, qualities that define the world of leveraged buyouts. Having navigated the intricate phases of a leveraged buyout, let's turn our attention to a real-world colossus that epitomizes the grandeur and complexities of LBOs, the legendary buyout of RJR Nabisco. This story not only marks a watershed moment in financial history, but also serves as a profound lesson on the dynamics of corporate power plays and financial engineering at their zenith. RJR Nabisco is a pivotal name in the history of LBOs, primarily due to its record-setting buyout in the late 1980s. RJR Nabisco was a large conglomerate formed by the merger in 1985 of Nabisco, a major food and snack manufacturer. Oreo is one of its famous products, and R.J. Reynolds, a giant tobacco company, has a large brand portfolio, which includes Camel, Newport, Doral, Eclipse, Kent, and Pall Mall. The story of its buyout became a classic tale of corporate and financial strategy, greed and ambition, famously chronicled in the book Barbarians at the Gate by Brian Burrough and John Hellier. The drama began in 1988 when F. Ross Johnson, the CEO of RJR Nabisco, proposed a $17 billion management buyout to take the company private in what would have been the largest LBO in history at the time. This initial offer set off a bidding war in the leveraged buyout market, attracting attention from several major investment firms and leveraged buyout specialists, including Kohlberg Kravis Roberts and Company KKR. The bidding war escalated quickly, with values reaching astronomical figures. KKR ultimately emerged victorious, closing the deal at approximately $25 billion, making it the largest LBO in history at that time. The buyout was financed through a significant amount of debt, which placed a considerable burden on RJR Nabisco's operations. The aftermath of the buyout saw RJR Nabisco struggling to manage this debt, leading to significant restructuring and asset sales. The deal became a symbol of the excesses of 1980s corporate America and raised questions about the value and consequences of leveraged buyouts for companies and their employees. The RJR Nabisco LBO remains a defining moment in financial history, illustrating the potential and pitfalls of leveraged buyouts and serving as a cautionary tale about the complexities of high-stakes corporate finance. In the wake of the global pandemic, the financial landscape has been irrevocably altered, giving rise to new challenges and opportunities within the LBO market. The third quarter of 2023 saw leveraged loan volumes reaching $94.3 billion, a notable 20% increase from the previous year, marking the highest volume in the past 5 quarters. This resurgence was driven, in part, by a significant uptick in LBO and M&A activities, with notable transactions reshaping the landscape. Among these emblematic operations, 2 deals stand out. The transaction for WorldPay, initially launched at $3.4 billion, was impressively increased to $5.2 billion. Meanwhile, Syneos Health saw its deal upsized from $2 billion to $2.7 billion. These transactions not only signify a robust appetite for quality assets, but also highlight a market adapting to the pressures of higher interest rates and tighter credit conditions. Yet, despite these positive indicators, the LBO market faces its share of headwinds. The total leveraged loan issuance through September 25, 2023, stands as the lowest output since 2010, a stark reminder of the market's ongoing battle with the aftereffects of the pandemic. However, this period of adjustment also brings a focus on higher-rated LBO transactions, a strategic shift towards more sustainable and prudent investment practices. As we move forward, the LBO market's trajectory in the post-pandemic world will undoubtedly be characterized by cautious optimism. Investors and stakeholders are navigating a landscape marked by both potential rewards and notable risks. This new normal demands adaptability, strategic foresight, and a renewed emphasis on quality and resilience. The leveraged buyout can unlock significant value, but it also carries risks. Let's first look at the brighter side. One of the key benefits of an LBO is the potential for high returns. By using a significant amount of leverage or borrowed money, investors can achieve a high return on equity, especially if the acquired company's performance improves post-acquisition. LBOs also offer tax advantages. The interest on the debt used for the acquisition is tax-deductible, which can significantly reduce the taxable income of the company and improve cash flows. Moreover, LBOs can serve as a catalyst for positive change. The pressure to service the debt encourages efficiency and discipline, often leading to better management practices, cost reductions, and strategic repositioning of the company. However, where there's potential for reward, risk follows closely behind. The high level of debt involved in LBOs can be a double-edged sword. If the company fails to generate the expected cash flows, servicing the debt can become a daunting challenge, potentially leading to financial distress or bankruptcy. The focus on short-term cash flow to service debt can also lead to underinvestment in the company, harming its long-term growth prospects and competitive position. Furthermore, LBO transactions can sometimes attract scrutiny and criticism, particularly if they result in significant job losses, or if the pursuit of short-term gains undermines the company's long-term sustainability. Leveraged buyouts embody the delicate balance between risk and reward in the financial world. They can unlock tremendous value under the right circumstances, but require careful consideration of their potential pitfalls. As always, due diligence, strategic planning, and prudent financial management are key to navigating the complexities of LBOs successfully. LBOs are a powerful tool in the world of finance. They allow companies with limited resources to acquire and benefit from larger, more profitable entities. Moreover, they offer opportunities to implement operational improvements and strategic changes that can increase the value of the acquired company. But how does this strategy help in raising money? Well, imagine a scenario where a company is underperforming. An investor, seeing the potential for improvement, could use an LBO to acquire the company, implement operational changes, and then sell it for a profit. The proceeds from the sale can then be used to repay the debt and provide a return on investment. In conclusion, a leveraged buyout is a complex yet powerful financial strategy. It allows companies to make large acquisitions using borrowed funds. It's a high-risk, high-reward approach, if managed correctly, can lead to substantial financial gains. Remember, the key to a successful LBO lies in the careful selection of the target company, meticulous planning of the acquisition, and diligent management of the acquired entity. And while it may not be suitable for every scenario, when used in the right context, an LBO can be a game changer in the world of finance. Thank you once again for joining us on this deep dive into the world of leveraged buyouts. If you found this video helpful and want to continue learning about the fascinating world of finance, don't forget to hit the like button and share this video with your friends or colleagues who might also be interested. We love hearing from you, so please leave a comment below with your thoughts or any questions you may have. And remember, to stay updated with our latest content, hit the subscribe button. Don't miss out on our upcoming videos where we'll continue to unravel complex financial strategies and concepts. Until next time, keep learning, keep growing.